It used to be that you went to college, got a good job with a pension, and rode that wave until the day you retired. Things aren't like that anymore. And we are 100% individually responsible for putting away savings so that we can retire. Not only are employer-paid pensions practically non-existent, but it's not common anymore to stay at a single company or even remain in a single career path long-term. For this reason, many of us have all partially funded, half-forgotten retirement accounts scattered throughout our trail of prior employers. If this sounds familiar, you're going to want to review all your old retirement accounts ASAP and start rolling each one over into a single consolidated account. You don't want to be on the verge of retirement attempting to remember all the way back to your 20s and 30s as to who you work for and what financial company managed that 401k, 403b, or IRA. That would be a disaster. It's a beating, but if you do what it takes now, find all the accounts and file all the paperwork, your future self and your family will thank you so much. Hi there, this is Harry Nima Segarra with Nima Equity, and today we will talk about retirement accounts, the value of combining or consolidating them, and how to use them other than for stocks and mutual funds, and to take advantage of diversification through them. Do you know you can use your retirement funds to invest in real estate? Sure can. There are absolutely some rules you need to follow in order to do this, but first, let's walk through a couple of hypothetical scenarios to see what you might be interested in investing in real estate with your retirement savings. Hypothetical situation number 1. Keep my money where it is. First, let's pretend you have $100,000 in a consolidated retirement account invested in a mutual fund. And let's say that over the next few decades, you earn about 7% in returns annually. You add $10,000 per year to the account with compounding growth. In 30 years, when you're at retirement age, what do you think you will have? $1.8 million. Not a bad deal. So you're thinking, I can handle that, right? Well, let's add inflation into the mix. Inflation historically has been around 3% per year, except in the last 3 years, of course, which means the cost of living doubles every 22 years. The $1.8 million sounds very cool right now, but that equates to less than $900,000 in today's money. Living out retirement on only $900,000 may not be doable depending on your expenses. Enter self-directed IRA. With a self-directed IRA, you have way more control over the types of investments you're allowed to make with your money. No more being limited to certain mutual funds, stocks, and bonds, although you can certainly invest in those if you want. Of course, there are some limits. You cannot invest in a vacation home for yourself, for example, but you can invest in commercial real estate syndications, REITs, ATMs, oil and energy, etc. These are passive investments where you direct the custodian of your self-directed IRA account to invest the funds on your behalf. Any interest profit earned from those investments go right back into your retirement account. Hypothetical situation number 2. Invest my money in real estate syndications with my retirement account. Now let's pretend that the same $100,000 was in a self-directed IRA account invested in real estate syndications. You invest in a deal with a 6-year hold time and a 2x equity multiple, which means over the course of 6 years, your initial investment doubles, roughly 16% annual returns. Although returns are never guaranteed in any investment, historically REITs and syndication returns have been above 10% per year. And yes, in the last 3-4 years, syndication returns were spectacular, sometimes over 20% per year. However, we should aim and be happy with anything over 10 to 12% per year, and that still beats the stock market by a mile. In summary, comparing the performance on returns in your retirement accounts when you invest in the stock market versus real estate is mind-blowing. And maybe I will explain this in a different video, but the key here is to take ownership of your retirement funds and invest and diversify in other types of investments. The magic word here is self-directed IRA or 401k. There are many other investment options out there, even outside real estate, that you can access with a self-directed retirement account. Now the thing is, you cannot take this choice when you are 60 or 65. This is a choice you have to make now. Even if you procrastinate another 5 years, you are probably missing out on hundreds of thousands of dollars. Do it for yourself, for your family, for your children. The sea of paperwork is worth it to prevent your 70-year-old self and your loved ones from experiencing financial stress and strained relationships because of money. Learn the lingo and do what it takes today so you can live a life on your own terms when it matters most. This is Harry Nima Segarra with Nima Equity. Thank you for watching, and I hope to see you again soon.